G'day everyone, Greg Canavan here with a Rum Rebellion market update for you. This week got a few different things to go through, but I want to start off with the housing market. Obviously it's always in the news in Australia, and last week there was a report out saying that I think the title of the report was "Let the Bloodbath Begin," and Aussie house prices are set, or Sydney and Melbourne house prices, which effectively are Australia, are set to fall 40%, and I thought that was a pretty bold claim. So in Monday's Rum Rebellion, I wrote about that, wrote about the fundamentals and why the fundamentals aren't currently supporting such a bearish outlook. I do think the housing market obviously is still probably got a little bit further to decline, but while the fundamentals are in place, by that I mean interest rates, increasing population, national income growth supported by commodity prices. While those things are happening, you're really not going to see a 40% fall in interest rates. But in today's update, I wanted to take you through a few charts that reinforce that view. The charts obviously tell you where the money is flowing in the market. It's not my opinion, it's what I guess informed capital is doing, which is why I like to bring up the charts in these updates and show you where the money is going rather than just give you my opinion. So the first chart I've got today, as always, it's a good one to start with when you're talking about housing markets. It's the banks. This one is the ASX 200 financials index, which is effectively the big four banks. And as you can see over the past few months, it's really rebounded, made a very sharp low in December around Christmas time there, and then throughout January and February so far, it's staged a pretty strong recovery. I've marked a few lines there in green showing that I guess the stepped process in the recovery. You've had a rally, a pullback, a rally, a pullback, and each of those pullbacks I guess terminated a higher point, which gives you an indication that the trend is starting to turn. The moving averages look like they're starting to turn up as well. So all in all, most of the bad news was priced into the banking sector at the end of 2018, and we're seeing a pretty strong recovery so far. Obviously, a lot of that had to do with the outcome of the Royal Commission into the behaviour of banks and the pretty soft outcome in terms of the penalties on the banks. So the market has liked that. The reason why I bring this chart up though is I want to point out that banks are not going to be rallying if the market thinks house prices are going to continue to fall. Banking bad debt charges currently are at almost very long-term lows. So we haven't really seen a pickup in bad debt write-offs from the banks. And if that was the case, if the market thought that house prices were going to fall further and it was going to bring about write-downs in property loans, then you wouldn't see this strong recovery in bank prices. I'm not saying that we've seen the bottom for banks. It's probably a little bit too early to say that. But right now the market is telling you that there's not going to be continued sharp falls in house prices. So that's exhibit number one. Let's turn to exhibit number two now. The chart I've got here is a company called Automotive Holdings Group. Now it's probably not the sort of chart that most people would bring up when they're talking about the housing market, but I find these companies quite interesting. This company effectively makes its money from car retailing, and for close observers or for a lot of people who just know how the market works in Australia, as house prices have been rising over the past 10 or so years up to the peak in 2016-17, a lot of people take equity out of those rising house prices to go and buy the next biggest expense after a house, which is a car. So car retailers have done very well for many years, but as you can see here, Automotive Holdings Group peaked in 2016 and started trending lower throughout 2017. And then obviously once the market realized that banks were going to pull credit and reassess their lending terms, then the share price really fell hard. So you saw a big decline throughout 2018 into the low at the end of the year. And similarly, again, this stock has started to rebound. Now it's too early to say that it's indicating that there's a bottom in house prices, but it's certainly saying that there's not a bloodbath going on in the property market, and we're seeing really heavy falls. So that's one stock. The next stock that's also a car retailer, AP Eggers, makes its money from used car and new and used car sales. Once again, this stock price peaked in 2016, started to fall throughout 2017, and then, as you can see there, in the latter half of 2018, started to fall sharply into a sharp low at the end of 2018. Once again, at the start of this year, you've seen a pretty sharp recovery in this share price so far. As I said, too early to say that it's saying that there's a bottom in the housing market or anything like that. But certainly it gives pause to the view that housing is going to continue falling sharply. And I think that the outcome of looking at these charts is to effectively say that house prices are adjusting to banks that are bringing their lending criteria back to a more normal level. That has certainly constrained credit, but you're not seeing the Reserve Bank increase interest rates. That is making it harder for people to get credit. You're still seeing net immigration up at reasonably high levels. I think in 2018 we had 300,000 people or net immigrants into the country, which creates demand for credited housing. And obviously commodity prices are still quite strong. I've shown charts of Rio and BHP breaking out to multi-year highs in the Rum Rebellion daily updates, and that tells you that bulk commodity prices are doing very well. And when that happens, you get income growth in Australia as well. So really, I think that, obviously there's an adjustment going on in the housing market, but to then become too bearish or panicky about it and assume that there's going to be ongoing falls year after year, I think that's overdoing it a bit at the moment. So let's change gears for a bit now. I want to have a quick look at the currency. The Aussie dollar fell again quite sharply last week on news. I think it was from Westpac, well-respected columnist Bill Evans said that interest rates were going to probably go down again this year, so the Aussie came under pressure. One thing I wanted to point out about the Aussie dollar here is that it's really a bit of a proxy for global growth. When global growth is strong, the Aussie dollar is quite strong, and when global growth is slowing, the Aussie dollar tends to do poorly. So as you can see there, the moving averages are still trending lower. And that tells me that there's not really any sort of optimism about global growth in 2019. So it gives me additional pause. And I've spoken before in these updates about the rally in stock markets and whether it can keep going. The Aussie dollar is telling you that there's not a lot of economic bullishness about the economy or the global economy in 2019. So that gives me, I guess, concern about this ongoing rally in stock markets. And we'll have a look at that a bit more in next week's update. Thanks for watching.